Well, hi everyone. Thank you for joining this panel today. My name's Yusuf Shadden. I'm the SME Investor Relations Manager at an organisation called the Connected Places Catapult. So the Connected Places is an innovation engine for UK science and tech. There's 9 catapults in the UK. The catapult I work with specialises in transport, travel, built environment, which includes things like decarbonisation, hydrogen, EV, alternative fuels, aviation, various different technology and transport. I typically work at I work with ventures at the pre-seed, seed, early Series A level, and as part of my work, I develop our investor network, and I'm regularly asked by my SMEs and ventures, well, Yusuf, should we speak to an angel, or how about a small VC, or how about a family office? So it's a real pleasure to be facilitating this panel today with these esteemed guests, because I'm going to be learning a lot too. So what I'd like to do is firstly just thank Wholesale Investor for putting on this event and for putting on this panel. So this panel is going to be called Battle of the Funders, from Startup to Growth. So you'll be hearing from the panel, and it's going to be a discussion around, well, really, who is the best type of funder, or the right type of funder for the different sorts of ventures that may be in the room. Part of this is going to also be to understand the importance of the different funders at different stages of a business life cycle as well. So just in terms of, just from the audience, can you put your hands up in terms of who's currently raising investment? Wonderful, okay. At the pre-seed level or seed level? Yep, Series A? Nice, Series B? Okay, anything after Series B? Okay, so we've got pre-seed, seed in the room. Great, thank you. So what I'd like to do is, first of all, introduce the guests. We have Engin. He's the founder of 21 by 21, an angel group with members in 13 countries, investing in early stage startups. After 20 years in banking and as a CFO in scale-ups, and 17 years in Japan, Engin has been back in London for 3 years, originally from Istanbul, but he hasn't lived there for 26 years. We have Mittel. She is an investor and a director in Citi's Market Strategic Investment Team based in London. She's worked for Citi in London, Hong Kong, New York, Sydney, and Sao Paulo. Her global career spans more than 12 years and includes strategic equity investments in fintech startups and financial market infrastructure companies, as well as new product development alongside traditional finance roles in banking and finance. We then have Bruce. Bruce is the CEO and co-founder of Bloc Ventures, a specialist deep tech venture capital investment company based in London. Bloc is a permanent capital vehicle with a very hands-on approach, focusing on early stage technology investments deep in the technology stack. Prior to Bloc, Bruce spent 12 years at Arm, the microprocessor company, where over his career he ran their strategic marketing team and also their corporate development team, in charge of global group strategy, M&A, and set up a corporate venture investment activity. Prior to Arm, Bruce spent 5 years at Texas Instruments, building MEMS devices in the fab. He holds a graduate degree in materials science from the Georgia Institute of Technology. And finally, Taras. Taras is a partner at the Fusion Group, a UK-based vertically integrated investment and wealth management group of companies with over 1.6 billion in assets under management. They're active acquirers and operators of financial planning businesses in the UK and opportunistic investors in wealth tech startups that provide synergies to the group. Taras is also a co-founder of Just FA, part of the Fusion Group, an all-in-one online advice and investment platform for their financial advisors. So please welcome the panel. Great, so just to start with, we're going to start our first question, please. Actually, we've got some opening statements. So opening statement first from each panel, about 2 minutes, 2.5 minutes on your experience and perspective on funding companies at different stages. So Engin, please, to start.
Sure. So I'll talk a little bit about 2121. It's 21 friends I've known for more than 21 years. It was one of those shower ideas, or ideas that came to me in the shower. Last September, I figured instead of writing individual angel checks, how could we actually how could I get bigger tickets together? And I don't love handing my money, not to speak against anyone, but I don't like handing over my money to funds. So I figured we could write bigger angel checks together. So I created a WhatsApp group of friends, and I said, guys, I'm going to be circulating some decks. Take a look at them, see what you like. So we're very agnostic in every sense of the word in terms of the sector, stage, and geography of startups that we look at. We're typically early stage. We closed 10 deals in the past 9 months. We invest our own capital. We don't have a fee structure. The 10 startups, the first 10 deals that we've done, 5 have been in the UK. One of them is actually in the audience back there, Farhan from Sari, which is a South Asian classical music app. The other 3 were US companies. We had 1 in Mexico and 1 in Turkey. In terms of the companies themselves, like I mentioned, we go everywhere from South Asian classical music to non-alcoholic beverages, going through machine learning and data science, in between an incubator of athletes in Turkey and a variety of other things. So it sounds like we don't have a focus. We don't. Our focus is combined brain power. Instead of me asking individual questions and getting individual answers, we ask a variety of questions and get different answers. So we look at quite a few decks. We have an initial sort of screening process where a couple of us have initial calls, and then we'll take companies to what we call a match day, where they come and present to the entire group. As was mentioned, we are spread across 13 countries, starting out in Buenos Aires and Mexico City, then New York, London, Amsterdam, Berlin, Lisbon, Istanbul, Adana, Dubai, Jakarta, and then finishing off in Seoul, Tokyo, and Sydney. I'll stop there and look forward to talking to you afterwards.
Great stuff. Thank you, Endin. Over to Mitchell, please.
Awesome. So I'm part of Citi's strategic investments team, focusing particularly on markets. And Citi does have a few different investing teams, so we collaborate with them, we co-invest. Our focus really is sourcing and executing venture investments into fintechs and early stage companies, as well as financial market infrastructure that are looking to drive innovation and progress across capital markets tech. So it could be anything from new market infrastructure, emerging technologies, post-trade efficiencies, all the way through to data and insights or trader insights as well. We are balance sheet investors, so we're not structured as a fund. We don't take any external capital, and we think of ourselves very much as a means to an end. So are we driving long-term strategic value for our markets business? In terms of our typical stage, we call ourselves stage agnostic. I would probably argue that we have engagements earlier stage and come in at the sort of Series A stage, but we do follow on as well. Typical check size tends to be in the single-digit millions range, but we don't really have a minimum or maximum. So my own insights from the last few years being on this team is that I think there's been a bit more patience for strategic capital. I think there's this misconception that it can take a lot longer to raise money, but I think it depends on what your solution is and what you're looking to achieve with a strategic partnership with the likes of a big institution. So happy to pass on to the next person.
Thank you, Mitchell. Over to Bruce, please.
Okay, I think one of the things, so Bloc is a deep tech investor. I'm going to do a pitch in a bit, so I'm not going to talk too much about Bloc itself. Just think about what we define as deep tech. Deep tech is generally thought of as usually a IP-rich, scientific, difficult type technology that's invested in. Our definition, we think of a technology stack. I think if in all cases, technology is developed in a stack. You have your applications at the top, say Facebook, but underneath that is a significant amount of technology that goes in to enable that application. And so where Bloc really focuses is things that are deeper in that technology stack. So that's why we call it deep tech. All the way down to the chip layer and really that sort of interface between hardware and software. Deep tech's a hard place to invest in. You got to be very patient. Recent data showed that deep tech, it takes about 20 more months as compared to most startups to scale. And that means 75 months, it goes to 95 months. Now the good side of it is that the same data also showed that the returns for deep tech generally are 26% IRRs versus the general 21%. So if you can wait a long enough time, you can actually see the returns. And the reason that is so difficult, what takes so long, again, think of a tech stack, but think of it more in a 3D, so almost like Jenga stack. And you're asking corporates and big companies and enterprises to insert a bit of your technology inside their tech stack that actually govern and run their entire business. That is a significant decision. It's a high-risk decision. And so they take a very, very long time to actually make those decisions, which then is really what pushes out that commercial cycle. Other side, once you're inserted in that Jenga stack, they don't want to touch it. So the longevity of those designs, which is why those sort of long-term returns come in. So it's a market we know. It's a market we've lived for the last 30 years of our corporate lives. And so that's our definition of deep tech.
Thank you, Bruce. And finally, Terrace.
Thank you. So in terms of what we do, we started as a hedge fund manager 20 years ago, and then we slowly evolved and added different parts to the business and in a value chain. So we moved from investment manager to asset allocator when we start allocating private capital to different asset classes. And then we saw an opportunity to build the business further, and then we start kind of buy and build strategy with financial planning firms. So our focus is on financial services and private wealth mainly, and our experience is a kind of principal investor. So we acquire and operate companies, so that's a value part of our portfolio. We also have a kind of a growth component, which is a technology platform that we recently launched. So that is more of a kind of growth startup story. We're privately owned, so we invest our own capital first. We grow kind of these individual ventures also, they're kind of linked and vertically integrated to a certain level. And then we're kind of open to external investors as well recently. And what is interesting is that by going through this kind of process of like let's say where you manage individual strategy, hedge fund, VC, that's kind of one mindset. Then when you start allocating assets and investing in the same either funds, mutual funds or VC funds, you see that you have different challenges, and quite often it makes sense why it was difficult to sell the fund or why it didn't go as well. So when you're an allocator, you have different challenge, and when you are principal investor or it's your own money or if you have a long-term horizon, then the challenges are very different as well. And from my experience kind of working with more of a kind of a startups, I'll probably talk about it a little bit later, is trying to understand this whole value chain and how your company will go through this journey is very important, because your conversations with VC early stage is what is on the agenda and what their goals are completely different to what it would be at a later stage. So it's important to understand and probably plan sooner rather than later.
Great stuff. Thank you, Terrace. So thank you very much for your opening statement. So I guess just to summarize, so we've got Engin Yenidura focuses on early stage Asian investing, friends and family rounds, initial funding. Mittal Patel, early stage strategic investments, building relationships, long-term corporate venture. Bruce Beckloff, specialist deep tech, Series A and beyond. And Terrace, specializing in long-term capital strategies and wealth management across integrated
using technology to make it affordable and available to more people.
Great, thank you. So so on this round we've got a pretty good base to cover with. Thank you. So just in terms of, so we're going to start with our first question, and we'll start with Engin, please. So can you tell us about your experience in startup investing, and what are the most critical elements you look for in a startup that makes you confident it can progress beyond the initial funding stage?
I knew the question a while back, but my answer keeps changing. What I just felt like coming out of my mouth was blood, sweat, and tears. Hopefully less tears and no blood and more sweat. But I think it's that non-stop, which doesn't mean 24 hours, but ability to hustle and stand up once you fall. That's probably the most important thing that we look at. obviously early stage, especially if when it's pre-revenue, there's not a lot of numbers to look at. Traction is great, but until it turns into revenue, it might just be a waiting list of people who sign up and are not paying anything. So that's hard to put multiples on, in our opinion. But it's that ability of the founding team to essentially pivot and come to an interesting, hopefully, conclusion in the next 5 to 10 years. I think that's the most important thing that we look at. As I mentioned, we all make our individual decisions. So I was actually asking the group what their thoughts were. And one of the ones I got this morning, which I liked, is the ability to talk startup and to talk finance. Because in the early stages, you're really talking about vision and where you want to take this company and all that. But then once you actually have numbers coming in, especially revenues coming in, then you really got to start talking finance, and you got to let your numbers talk, but you also should know how to make your numbers talk. So as things get more numerical, we love people who can put their numbers into words, who can work with numbers. We love looking at models. We know not everyone has a financial background, but we like that vision to be put into numbers and to be presented in a way that looks interesting for both the founders themselves and the investors. The other thing that I always say, and I'll finish with this, is an understanding of what capital structures look like. Two words that every founder that I talk to should understand: liquidation preference, or generally preferred shares, what they mean, what common shares are, the kinds of shares that investors take. You will never, 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 ever be able to make money with your startup if you don't understand what you're giving to investors. And your understanding of that will determine what the next group of investors will do based on who you already have on your cap table. And I'll stop there.
Great points, thank you. So we've got obviously the blood, sweat and tears, but hopefully less of the blood. So tenacity, perseverance, that 5 to 10 year approach, understanding of the long-term capital structure and the numbers. It's interesting to mention that because I spent 7 years working in impact investing, and most of my startups and ventures I worked with had the lived experience of doing whatever they're trying to fix with education, employment, criminal justice, whatever it was. And they didn't have any kind of finance background. A big part of my role was translating their vision and their business and their idea into the numbers. Because when we're talking to investors, it's about the numbers and social impact and other measures. Just to bring actually Bruce in. So obviously, Engin mentioned he's looking at kind of 5 to 10 years, that vision. So working in deep tech, where a lot of this technology is, I guess, unproven, or do you work with kind of semi-proven technology? Where do you kind of base yourselves in terms of looking at that exit horizon as well?
So I think we're probably more of a pre-A investor. And again, venture actually is pretty simple. It's pretty formulaic, right? There's different stages. It's pretty well defined. And actually, you can probably figure out the valuations you need at each one of those stages. Because you, as an investor or as an owner, you only want to give up somewhere between 20 to 33% of your company, and the VCs want more and you want less. But that's basically it. And then you take how much you need to raise and you divide it by that, and then you basically figure out your valuation. So it's not really that difficult. The stages that you look at then are the sort of different value creation stages along the way. So, the seed and this is deep tech, in seed and deep tech is really the proof of concept. So you've been able to show it to a customer and somebody's been able to buy it. And actually, that's pretty easy for a deep tech company to do, to get one customer, because you can basically create a bespoke answer for somebody. Then where we come in is really it's called the valley of death or whatever, because the next A stage is really about sales. And that's really when you've got probably 3, 4, 5 customers lined up. You're selling things again and again in a very similar way. Those structures are signed up. You've got a pipeline. You've got these sorts of things. And the valley of death that everybody calls it is that place in between, the place between the easy 1 customer and the very difficult 5 customers. And so where we really like to invest and get engaged is in that productization and commercialization stage. Because again, it's very easy to create a bit of tech that you can sell once, but create a bit of tech that people can buy repeatedly over and over again, not just the number of customers, but the tech to be able to service a customer over and over again is actually quite difficult. And then to go find them and having the commercial structures. And again, we find in the UK, this is one of the, not only is it a valley of death, but this is a very big gap. It's a very big gap because the commercialization of technology over here is very difficult. The technology is so rare, the reason a company fails. The technologists are great. You know, you could use the old, you know, adage, it either turns on or off. It's binary, haha. So you guys didn't get that. But so so we spend a lot of time on the commercialization plans. How are you gonna sell this tech? We don't really care about exit plans because I ran the M&A group for ARM. I never bought anybody who was trying to sell to me. I bought people who were causing me pain or going to generate a new revenue stream for me. So I wouldn't worry so much, or at least if you talk to us, worry about the exit. But really, how are you gonna go from 1 customer to 5 customers to 10 customers? And then really, when are you gonna move to the US? Yeah, let's not, or when are you gonna start your US? And I'm gonna talk about this in a second. Yeah, you can hear my accent, but the fact of the matter is the risk capital's there, the long-term risk capital, the acquirers are there, the customers are there. We have a great, in this, again, I'm speaking about deep tech, not some of the other more high-level SaaS and things like that. But when you're talking about some of the deeper technologies, the really large tech companies that you're going to be able to sell into are likely going to be in the US. And so that has to be a part of your process. And that happens again after Series A. So you kind of go proof of concept, commercialization, sales expansion, so getting your 5 customers, you know, global expansion, which means move to the US, and then, you know, growth capital exit. And that's, or IPO or do whatever you want, but you know, that's generally the sort of structure we see.
Thank you, Bruce. I mean, you've mentioned some really interesting points there. I mean, it's great to hear that you're not necessarily looking for that exit strategy or that exit vision straight away. You're believing in the technology, that piece around, you know, 1 customer to 5 customers to then growing from there. The valley of death, I think that'd be good. Another, we'll talk about the valley of death in a moment. One of the challenges I also see in the UK is you know, we have some good level of pre-seed funding. We have seed funding. We've got some good Series A, but we are missing that Series B and above. And one of the things that my organisation is trying to do is we're actually trying to keep UK tech startups in the UK, because as soon as the investment comes from outside of the UK, I was in Singapore recently, and they've got one of the most world-class leading facilities for maritime tech and maritime testing. And they're encouraging European startups, American startups to go to Singapore. The regulatory framework's a bit easier as well, with things like autonomous vehicles and ammonia. But yeah, I'm trying to explore how we can keep more of that science and tech in the UK, but thank you for that. And going over to Mittal, so because I know that you work with, when you work with your organisations and your clients, you're also looking at building that longer term relationship with them as well. Can you tell us more about that, please?
Yeah, so a key part of our relationship building or engagement comes down to the fact that all of our investments require business sponsorship. So I think Taras mentioned earlier, you have different lenses that we're taking a look at from an investment standpoint. And so you've got the traditional VC lens, which is, you know, do we have conviction behind the management team? Is there an attractive market opportunity? Do we think that the valuation makes sense? And then you've got strategic returns, which is how engaged is the business on this opportunity? And what that means is, do you have someone who in an operational capacity understands what you're trying to do? So although we might actually invest in a startup around the Series A stage, the discussions with our business start a lot earlier. And so my advice to founders and CEOs quite early stage is have those conversations with the person that you think is going to be utilizing your product, particularly in a large behemoth like Citi. Try to use your contacts to get your foot in the door and understand from a very early stage, is this something you'll use? And then go through the feedback loop, because that way you can demonstrate your traction and your progress consistently. And so when it comes to the point of investment and you're going through those decision-making points of, do I want this strategic partnership and investment, you're able to clearly articulate why that might make sense. Because the question we're asking ourselves as investors is, what is the clear justification for making an investment in this company aside from just a vendor relationship? So I think the 2 points that we often look at when we're first engaging with companies or trying to put them in front of our businesses, be it a trading desk, for example, is have you already established that product market fit? Are you already at that point? And how scalable are you, right? You're going to be used by potentially thousands of users in a huge organization. Do we think that this is a scalable solution? So being able to demonstrate that you understand that and the challenges, as well as articulate very clearly, as you guys have already said, what that means for the company. I think the strongest founders and CEOs I've seen are the ones who can connect the dots and very early have that engagement with a business sponsor to say, hey, this is why it might make sense for you to take a stake in our company, and we'd love to have you on our board, or we'd love to have that constant feedback with you. I do think it makes sense a little bit earlier to do that, because once you get to that Series B stage, you know, there's very little in the way of product influence that you can have, and so may not make sense for our mandate, but it could for others.
Interesting, thank you, Matilda. So for Citibank and I assume other corporate ventures, it's about building that longer term relationship. You're looking at it for the, you know, in the long term. You're looking at these strategic investments or acquisitions because you're looking at embedding them into your different parts of the business?
Looking to either integrate them into what we do already. So we only ever take minority equity investments. We're a large regulated firm. And so we work with our innovation labs to run POCs and pilots to understand if a solution could be integrated at Citi or utilized by someone, right? It could just be something that's used daily by someone to inform a trading decision. But equally, we also think about ways to help the company grow. So as investors, we continue to stay in touch with the company and maintain that sort of corporate guidance and governance. But once we've made the investment, it sits with our business. So really, they're incentivized to be implicit in the growth of the company and the success.
Yeah. Okay, thank you. And so, Taras, over to you. And then in terms of when you're looking at early stage organisations to invest into, how would you and your fund assess the longevity or the product market fit or how far that particular organisation is going to be able to scale?
Before I answer this question, I just wanted to make a little comment. So it's definitely important to get the market fit early and understand whether, especially within the corporate venture side, because this is a business that needs to have certain synergies. It's not a VC 5 years where you just basically kind of grow, exit, and new large investor comes in at different multiples. So apart from a product market fit, and I think it's also why at a later stage, this kind of valley of death trap is that quite often people will say, yeah, it's a great idea, I will use it. Then you start doing something, and then if it's, and especially like in a B2B, when you start actually implementing it, you might not sort of something that like 3 steps down the line, you need to have a certain integration, and this integration doesn't work or it conflicts with something else. So that's kind of another thing that to think, not just whether there is an interest, but actually how it can be implemented and how it can be done. So in terms of, from our perspective, when we look at companies, I think as a principal investor, ultimately is an asset owner. Asset owners and a lot of the investment decisions are driven by them. So it can be retail, it can be private wealth, it can be institutionalized private wealth, which is like family offices, and it can be institutional insurance, pension, stuff, and corporate ventures. And everyone would have different interests. They would look at investing from a global asset allocation perspective, and they would have different public markets, private markets, different buckets of risk, different strategies, so whether it's capital preservation, whether it's capital growth, and then money would be allocated to, let's say, if it's a high growth risky business, then, it's maybe like 10-20% allocation. Then if it's a value business, if it's a fast growing company, but they generate enough revenue, they have healthy profit margins, and they grow fast, that's more of a value story. If it's a companies that growing really fast but not generating enough revenue to cover the cost, that's kind of a more risky story. So this is how, and then it also depends kind of on implementation. So if someone is, investing in companies directly, you need to have capability, and you might get a bit higher return, but then you spend a lot of more kind of time. You can get exposure to certain even new and high growth sectors through different instruments, or maybe public market index, or kind of investing in VC or doing directly. So from our, kind of what we do, we're very specialized and we, work in financial like this kind of financial planning space. But think about it from an asset allocation perspective, buckets of risk, private public markets, and how, everything can be kind of achieved.
Okay, so you're looking.
So if it's a growth story, you might kind of allocate a bit of money from your portfolio and with a view to exit in a few years. Or if it's steady profit-generating business and it has a growth potential, and it also comes down everything to price, what price you're willing to pay and how much the asset costs.
Yeah.
Not just whether you can raise money or not. That's another consideration.
Yeah. So very much on a case-by-case basis, project by project, investor by investor.
I would not say case-by-case basis, but more there is like a matrix, and you have your asset allocation portfolio, different asset classes, different buckets of risk. So it's understanding where a particular investment sits, and then analyzing this investment with this kind of particular lens.
Okay, thank you. So one of the points that came up a couple of times was around the value of death, and going back to Engin, please, in terms of the startups that you've invested into, how do you support your startups, or how does the fund support startups when they're getting into that value of death? Do you try to pre-mitigate some of the risks, or does it just kind of happen anyway, and then you need to kind of see them through it? How do you handle that stage of the growth of venture?
Well, one of the things, the main thing that we bring to the table is our network. Obviously, it's a global network, and I think that's a lot of the introductions is what we basically try to help the startups with. During I like this 1 to 5 customer analogy. One of our most recent and biggest investments, called 3LC, we actually have a session with them. All of us that invested in that, which was 21 of us, they're gonna be telling us about their ideal customers, and we're gonna be making introductions sort of based on that. So that is one of the things, opening up our network basically, and actually taking actions around that. That's probably the most important thing that we're bringing to the table in terms of helping them try to jump or see through the value of death. When it comes to funding, sort of through the introductions, one of the things that we do, we sometimes co-invest with VCs as well. Mm-hmm. We might be getting a part of their allocations. The other thing that we do is sort of, if we've done a pre-seed investment and they're raising a seed round, we'll basically introduce them to the VCs that we know that we may want to bring into the cap table ourselves. And I think that is an interesting way of looking at the funding cycle as well, because as you grow, the kinds of investors that you're going to be attracting is also going to grow in terms of size and fund sizes and sort of allocation ticket sizes. So sort of looking at groups like that that can actually hopefully carry you across the value together with your revenues and sales. I think that's the other thing that is interesting to keep in mind.
Thank you. So it's very much about using your network and network of networks. Okay, great. Thank you. And how about from a Bloc Ventures perspective, Bruce?
Well, I think the whole basis of Bloc, the definition of Bloc, is a group of people coming together for a common purpose. That's why we're called Bloc Ventures. When we ran our corporate role, and I'll tell you about the team in a bit, but we had a very focused group of shareholders. It was ARM. ARM cared about what I was doing, and so I had access to the researchers, to the sales, and all of that to bring that to bear onto the startup. It's exactly what Engin said. It's network. I use this analogy. It takes a village to raise a child, and if you think about a startup, in those early days, it's really toddler years, and then they grow up, and at the Series B, it's like you see them on the weekend for 6 seconds. So that's it. That really is the whole basis of that of what you need, and it's probably one of the most disappointing things to me as a VC working with other VCs in the region, is the lack of network that you have to bear. And again, if you compare it to a US VC, you sit down and they go, okay, let's open up the network. We're going to find out who to connect you to. Because at that early stage, you don't have like a 200K a year CCO that has a massive background and network to go out. You've got no money and you've got to find 5 customers. And that's the big challenge. I still think that valley of death here is difficult because the investment community doesn't necessarily have the network to really help the companies through that valley of death, which is really all about, in my opinion, commercialization.
Thank you. Thank you. And from your perspective, Mitchell, given that you're building up the relationships with your investees, with the ventures quite early, you're investing in that Series A round or thereabouts. At the point of investing, are the ventures you invest in, have they already gone through that valley of death, or?
Yeah, I would say so. Although we have invested earlier stage where we've gone through that with several companies. And again, we have to leverage our network too, right? As a strategic investor or CVC in general, I think that's one of the biggest pluses, that you can leverage the network of that person or that team. That said, I think that it's kind of incumbent on any investor really to ensure that they're doing what they can for their portfolio companies, to connect them appropriately. We've often found that we co-invest with other VCs. We also make investments as an LP into funds as well, and we also co-invest with our peers, so other strategic investment units at banks. So the likelihood is, if you've demonstrated that your solution works for the likes of a Citi, it will probably work elsewhere. And so you can then take that, and it helps you demonstrate that your solution has been de-risked. It helps with adoption and credibility as well. But the point about investment is we do sort of new follow-ons, we do new investments, we follow on, and we both lead and follow in terms of rounds. So I think that for us, depending on what we can and can't do in terms of a strategic use case, and the business sponsorship is very separate to, once we have a portfolio company, how we continue to support them.
Great, thank you. So just at constant, we've got 3 minutes left. What I'd like to do is start asking for closing remarks, please. So maybe 30 seconds or so on your kind of main takeaways or main items to share with our audience here. Teres, if you'd like to go first, please.
Well, I think I can just repeat what I said. I think it is very useful to understand like the whole chain where, and kind of the trajectory of your startup will be going through, and the funders, and what drives, the investment decision. And the earlier you can plan it, the better. And another point is that, with any kind of startup or new business, it's important to get the market fit, but also, again, think through different stages of this kind of technology kind of adoption. Probably less relevant in B2C space, but in B2B, it's most likely the case why kind of companies can stuck in this valley of death, can't generate revenue as fast as they can, as they want, or can't rise kind of follow-on rounds or show enough traction.
Great, thank you. Bruce?
Not sure what to close. I mean, I just would encourage on both sides, because again, I'm speaking my own book, try to find smart, caring money and people that really want to be in it. I mean, again, with the angel network, again, with Ingen being involved, that's incredible, because quite a few times you get an angel and they're very busy. They usually have their own day job. So how are they going to spend time helping you? So, try to find people if you can. By the way, I totally get that the funding environment in this country right now is dire. And so you're kind of like, take money wherever you can find it. So, I'm not so precious. But that, if you can find a good, interested investor that can help you out, that's going to open up their networks, they're worth the price of gold.
Absolutely, thank you. Engin?
I like the smart money expression. I'll say 3 words: do your homework. When you reach out to people, remember they get a lot of emails, especially when it's cold outreach, when you have to do cold outreach. Just put something in there that's going to pique their interest. Look at what they've done. Spend 10 minutes before you send out that one email. Think of it like you have one shot, right? You have the chance to actually shoot it and really hit it. Don't waste it. Typos in emails, I don't look at. I literally stop looking. Typos in decks, I stop looking. If you haven't done your homework and done your spell check, I'm not going to be investing in you. We're not going to be investing in you. It's that simple. So take the time to reach out, before you ask for people's time to give you 30 minutes. Spend 30 minutes before you actually reach out to them, because it might be a very valuable 30 minutes you just wasted.
I wholeheartedly agree. And the thing that I would say is I always see people underestimate the time and commitment that's required from a resource perspective when you're an early stage company to engage with a strategic investor or CVC. Make sure you know what you're getting into and don't spread yourself too thin, because it is very apparent. So.
Just budget that whatever you think it will take, and
Yeah.
it will be like 3 times longer and 5 times more expensive.
Absolutely. Yeah.
Excellent. I mean,
Regardless what you plan.
so excellent points. I mean, we could have, I could have spent hours talking to you guys. It's been really, really interesting. Thank you so much for giving up your time today. Thank you, panel, for sharing with us your perspectives on different areas of growth investment. Thank you to the audience for joining us. I think that just gives us the opportunity to, well, really wish you the best of the rest of the day and enjoy the rest of the conference. Thank you.